Double entry in bookkeeping. This is one of the most important video in accounting because here we will finally understand how bookkeeping actually works and what T-shaped accounting really means. So in this video, we are going to understand a few important things.
Hello everyone, welcome to this Pro the Journey YouTube channel. I am Mr. Rai. I help you study professional knowledge in a simple and a practical way. So let's start.
We'll look at the type of transaction, how double entry actually balances, what supporting documents are used, and how T-shaped account works. So let's start simple. Think about business like Amazon, Walmart. They handle millions of transactions every day. Now imagine recording every transaction manually one by one. That would take forever and create a lot of confusion. So people creating accounting system and softwares to organize everything properly. From recording transaction all the way to preparing financial statements. Now here's the idea. Business transactions are divided into two categories. Routine transactions go into the book of primary entry. Occasional or non-routine transactions go into the journal. So let's first understand book of primary entry. These books are used to record large volume of daily transactions. At the end of the day, total from these books are transferred into the ledger account using double entry. Some common books are like sales day books for credit sales, purchase day books for credit purchase, for goods returned by customers, purchase return day book, good return to suppliers, cash book for all bank transactions, petty cash book, small cash expenses. Now the journal comes. Not every transaction happens daily. Some entries are unusual or happen occasionally. Those go into the journal. For example, depreciation, bad debt write-off, buying or selling non-current assets. So basically, if a transaction doesn't fit anywhere else, it usually goes into the journal. Now let's move to the core concept, double entry system, also called as duality principle. This means every transaction has two effects. If one side gives, the other side must receive. And this keeps the accounting equation balanced. Example, asset is equal to equity plus liabilities. Here is simple way to think about it. If you give someone a gift, there must also be someone receiving that gift. Accounting works the same way. Every transaction affects at least two accounts or ledger accounts. Important point, all transactions are recorded from the perspective of the business itself. Not the owner. This follows something called the business entity concepts. Let's have some practical exposure. Suppose a business pay rent of $2,000 through the bank. What happened? rent expense increases, cash in the bank decreases. So one account goes up and another goes down. The equation still balances. Let's see another example. Suppose a company has asset $1,000, equity $500, liability $500. Now rent of $200 is paid. So before the payment, asset $1,000, equity $500, and liability also $500. But after the payment, cash reduces by $200. Equity also reduces because expense reduce profit. So the final position is asset $800, which was $1,000 earlier, equity $300, which was $500 earlier, and the liability is same earlier and now, which is $500. Still balanced. That's the beauty of double entry. You can also practice this using any accounting reference book so that you can understand it more better. Now, after understanding double entry, let's move to supporting documents, because every transaction needs proof for the authenticity of transactions, specifically since the business and the owner are treated separately and they are actually separate. Management and owner are two different parts. Supporting document is a systematic process where everything needs to be verified and clearly recorded. Let's discuss it step by step. Step 1 is quotation. A business first reaches out to the suppliers and asks for quotation based on what they need. Then this includes details like quantity required, description of good, price. Usually, quotations are requested from multiple suppliers so the business can compare price and quality among these suppliers. After first step quotation, the second step is purchase order. After choosing the best supplier, the business sends a purchase order. This confirms the quantity, price, and the agreement in the order, so the offer mentioned in quotation can be officially accepted. Now step 3, which is sales order. Once supplier receives the purchase order, they prepare a sale order. This is mostly for internal use to verify details and instruct the warehouse to process the good. After third step, sales order, we have step 4, which is dispatch note. The warehouse sends a dispatch note. This proves the good was shipped, so the buyer can check everything once the good arrive. It usually includes supplier details, quantity sent but not fully, price detail like an invoice. Now the 5th step is good receiving note. A good receiving note is used to confirm that the buyer has received the goods. It helps the business check whether the correct item and the quantity were delivered before accepting the shipment officially. This confirms good arrived safely, correct item were received. And 6th step is sales invoice. After receiving the good received note, the supplier sends the sales invoice to request the payment. This contains detailed information like price, quantity, tax, credit terms, payment details, and yes, businesses often buy goods on credit, meaning they will pay later. Not debit credit accounting here, just delay payment. Next is purchase invoice. However, it opposite of sale invoice. Similarly, when a business sells goods to customers, it sends a purchase invoice to them. Now let's look to the seventh step. Sales return and purchase return. Now suppose goods are returned. Let's start with the purchase return. The buyer sends a debit note to the supplier. This means goods are being returned, so we will reduce the amount payable. For example, a credit purchase had been made of amounting $4,000. So the entry is purchase account debit to $4,000 to payable account $4,000. Then good worth $400 are returned. Then the entry will be like purchase return account debit 400 to purchase account credit 400. And then payable account debit 400 to purchase return account credit 400. Sometimes businesses also pass a net entry instant. After receiving the returned goods, the supplier issues a credit note. This confirms goods were received back, amount owed has been reduced. Similarly with the sales return. Goods were received back, amount owed has been reduced. Now with the sales return, which is similarly with the purchase return. Now the final step, which is eighth, the payment step, which is remittance advice and receipt. Finally, the businesses pays the amount owed along with payment. It sends a remittance advice. This tells the supplier, we have made the payment. Please check the reference details. This helps avoid future payment disputes. Then the seller issues a receipt to confirm the account has been settled. Then the supplier issues a receipt to confirm the amount has been settled. Now let's move to the ledger and journal ledger, which also sees as a nominal ledger. Let's first move to ledgers. A ledger account record transaction related to specific item like asset, liability, equity, income, and expenses. Because of double entry, every transaction affects at least two ledger accounts, one debit and one credit. Now journal ledger. The journal ledger is simply the complete collection of all ledger accounts used by a business. You can think of it as master list of accounts. Type of ledger formats. Generally, ledger account appears in two formats. One is traditional T-shape accounts. This is very important for exams. The other format shown, opening balance, debit, credit, and closing. Often this format is used by the softwares. Vary businesses to businesses. This format is useful for understanding movement during the year. Now T-shape account. This part is very important. Please remember this carefully. A T-shape account has two sides, debit sides and credit sides. Now these two sides help record all the important transactions in accounting. And here the things, the entry accounting should mainly depends on the 5 elements of account, which is asset, liability, capital, income, and expenses. So every business transactions is recorded using this element through the debit and credit sides of the T accounts, which we already discussed in earlier videos. So if you haven't watched them yet, make sure to check them out first in order to more clarity. So now let's dig into it. Debit side usually includes increase in purchase, increase in expense, increase in assets, drawing and dividend, and the opposite decrease go on the credit side. Now credit side usually includes increase in income, increase in liability, increase in equity or capital, and decreases go on the debit side. Now let's understand this with a practical example from journal entry all the way to trial balance. Mr. Virat started a clothing manufacturing business. During the first month, this transaction happened. Invested $20,000 into a business from his bank account, paid rent for $1,000, purchased equipment for $12,000, purchased fixture for $2,000, brought raw material for $700 on credit, which is not in cash. Received cash from customer worth rupees $1,650. Now the journal entries. So first we will be prepare the journal entries like cash account debit to $20,000 to capital account credit $20,000. Rent paid account debit $1,000 to bank account credit $1,000. Equipment account purchase debit $12,000 to bank credit $12,000. Fixture account debit $2,000 to bank account credit $2,000. Purchase account debit $700 to payable account credit $700. Cash account debit $1,650 to sales account credit $1,650. Now let's move these into the ledger account. Here's the key thing to remember. A ledger records the opposite account name. For example, cash comes from capital. So in the cash account, we write capital on the debit side. And in the capital account, we write cash on credit side. Simple idea. Ledger account do not record their own named balance. If this would happen, the dual concept fails to apply. Now think about the rent. Rent expense increases while cash decreases. So rent goes the debit side, cash goes to the credit side. Since ledger record transaction with the opposite named, therefore balances will be recorded like this. Rent will go here and cash payment will go here. Same logic applies to the equipment and fixture. Asset increases goes to debit side with the name cash ledger, and cash decreases will go credit side with the name assets. Now let's move to the purchase. Please remember, recording will be done in the opposite names. Similarly with for purchase. Expense increases, debit goes to the debit side, cash or payable increases goes to the credit side. And for sale receiving cash, cash increases goes to the debit side and sale income increases goes to the credit side. After preparing all the ledgers, the next step is preparing a trial balance. This is called using the closing balance of all ledgers. Some balances are carry forward and some are brought forward. And after the trial balance, we move to profit and loss account and balance sheet, which we'll cover in the upcoming videos. Till then, look at our playlist coming on screen and make your career more stronger. Please subscribe and comment. Please also share your feedbacks, which is very important for us. Thank you very much. Let's meet into the next video.